Michael Burry, one of the few who accurately predicted the great financial crisis and profited massively off of it, just unveiled his newest big short since the financial crisis with a $1.6 billion bet on a stock market crash. But the devil's in the details, and there is much more than meets the eye here. It may not be exactly what it seems like on the surface. The 13F filings of Scion Asset Management were just released, and they show two massive positions against the stock market. One of these is a $739 million position against QQQ. This is a popular ETF that tracks the NASDAQ. The second position was an $886 million position against the S&P 500. The cumulative $1.6 billion between the two positions represents 93% of the entire fund's portfolio. But not so fast. Remember, these are options, and just like the authors of many of these articles, many people do not understand how options work. Because on the surface, it looks like Michael Burry just shorted the market with almost his entire portfolio. And in reality, that is not what happened here. There are two major details missing from these filings that prevent us from knowing what the exact position value is. The first piece that we have to look at is notional value versus market value. And then the second piece that we're going to look at is the missing short position. Now you're probably thinking, but wait, this is a $1.6 billion short on the market. So what short position could possibly be missing? We have to remember these are options. And so while the position itself is a short on the market, the trade is long puts. And I'll show why that matters in a moment, because this could be part of a larger trade that may not even be directionally bearish on the market. If you don't know who I am, my name is Joe Brown. I run Heresy Financial University, where I teach investors how to get higher returns while taking on less risk on their portfolio by understanding how markets work. And this entire video is going to be dedicated to just that. I got my start, my background is in options trading. This is my bread and butter. This stuff is very exciting to me. And using options trades skillfully and conservatively allows you to follow along and trade along with some of the most advanced investors and successful investors like Michael Burry, and make massive profits if there is going to be a market crash, but also limit your risk so you lose very little if that directional move does not happen. Take, for example, the company Apple. Let's say you've been watching the stock price of Apple rise from $30 per share all the way to $177 per share where it is today, and you think it is due for a correction. One way you could profit off of a fall in the share price of Apple is to simply short the shares. Mechanically, what's happening when you're shorting shares is you're borrowing from somebody who owns those shares, and then you're selling those shares to somebody on the market. You receive cash of $177 per share, and you owe back the number of shares that you borrowed. At some point in the future, let's say you're right, the stock price of Apple goes down, let's say to $150 per share. You buy back shares from the market at $150 per share and deliver those shares back to whoever you borrowed from. Because you sold at $177 and then you bought back to close at $150, you notch a nice profit of $27 per share. The problem with this trade is the unlimited risk to the upside if you're wrong. You see, if Apple goes from $177 per share back up to its high of $200 per share, you would then be sitting on a loss of $23 per share. But technically, whenever you're shorting shares, your risk is theoretically unlimited, because that stock could go to 300, 400, 1,000. There is no upside cap on how high a stock could go. And since you borrowed and sold the shares, you have to deliver shares back. You don't owe a certain dollar amount, you owe the shares back. So if the shares hit $3,000 tomorrow, you'd have to buy enough shares back at $3,000 to deliver them back. Now, in reality, you'd get a margin call far before the shares hit $3,000 per share, but you get the point. When you short shares, you're betting on a downside move, but your risk is unlimited. This is why instead traders many times prefer using derivatives called options contracts to short the shares instead. This particular trade that you see mocked up on the screen here is called a put. And if you buy a put, it gives you the right to sell the shares at the strike price, in this case, $140 per share. There's always an expiration date with options, and this one expires in December, and the current cost of this contract is a little over $1 per share. So this contract, I can buy from somebody else the right to sell them shares of Apple, in this case, at $140 per share. If I open up this contract and then in the next month, 2 months, 3 months, the price of Apple drops, let's say to $130 per share, then me having the right to sell shares of Apple at $140 would be very valuable. It would be at least worth $10, the difference between Apple's price of $130 and the contract strike price of $140. But as you see right now, the contract is trading for $1. This means if I bought 100 of these contracts, I would still only be spending $10,000. Now, if we do some quick math here, we can multiply the strike price of $140, which is the price we would sell the shares at, by the number of shares represented in each contract, which is 100 shares, and then multiply it again by the number of contracts we are buying, which is 100, and we can see that we are controlling $1.4 million worth of Apple shares. Yet the amount we have to spend on the trade is only $10,000. This is the difference between notional value and market value. This trade is going to cost us $10,000 to execute. But should we exercise the rights that this contract gives us if Apple drops and we actually use it to short the shares, then that position would be a $1.4 million position. So when we take a look at the new positions that Michael Burry opened up with Scion Asset Management at $739 million for the QQQ puts and $886 million for the SPY puts, these are notional values. Regulatory filings right now do not require the disclosure of the strike price of options or the purchase price or the expiration dates. So we know that if these specific contracts were to be exercised, the notional value, it would be worth $1.6 billion. But that's all we know. By the way, guys, I'm going to be speaking at the Stock Pulse Silver Symposium about the history and future of sound money. It's in Las Vegas from September 29th through October 1st. There's going to be a ton of other great speakers there. There are going to be plenty of opportunities for us to do meet and greet, hang out, get some drinks together. I'd love to meet you there. And everybody who shows up is going to get 1 ounce of silver as well, a 1 ounce silver coin. So I'd love to see you there. There's a discount link, 10% off in the description below. So sign up there, get that discount, and tickets are running out, so sign up soon. That is far from enough to understand how big of a position this really is for his overall portfolio. And let me demonstrate by building out $1 billion position against SPY right now. Just like we did with Apple, we can mock up a trade with SPY. First, we can see that SPY, which is the ETF that tracks the S&P 500, is trading near its all-time high. If we wanted to hedge against a major market crash, we might expect that the S&P 500 could fall down to $200 per share or more. So choosing the end of the year for the time period in which we want to hedge and choosing the 200 strike price put option, we can see that the price per contract is trading at a measly 14 cents. This allows us to buy 50,000 of these contracts for only $700,000. Quick note, that's not actually real. There's definitely not enough volume on those contracts to be able to purchase 50,000 of those at that price. It's just an example to show you how small Michael Burry's trade may actually be. So if we were to buy 50,000 of these contracts at 14 cents a piece, we're going to spend $700,000. Just in case you did some quick head math there and you think that we're missing some zeros, it's because every contract represents 100 shares. And so you have to multiply that 14 cents by 100 first, and then by the number of contracts you're buying, 50,000, to get the full $700,000 number. So why did I choose 50,000 contracts? Well, let's do some quick math. 50,000 contracts times 100 shares per contract times $200 per share equals $1 billion. So for only $700,000, you could build a position that in a 13F filing would look like $1 billion short. This is why, depending on the strikes that Burry chose and how much they cost, the size of the position in his portfolio could be much smaller than the notional value. Now, don't get me wrong. By itself, this would still be a major short on the stock market. And he probably did have to spend more than $700,000 on this position. The liquidity is not there on any of these contracts to just buy one of those, so he'd probably have to space it out and enter into this position leg into it over time. So again, by itself, this position would be very profitable for him if the stock market did crash and he still owns those puts. But we have to look at the next missing piece of this, which is an offsetting short position. As some are already pointing out, this trade may be part of a wider scheme with a longer term goal. This is because filings are only required to disclose long positions, not short positions. Remember, these are puts that Michael Burry purchased. So because he purchased these, he has to disclose that. But with options, just like with stocks, you can short those exact same positions. So if you buy something for $100 and you short something for $90, together you only spent $10. It's very possible that Michael Burry constructed a very similar trade here, where he shorted the market by buying contracts worth a notional value of $1.6 billion, but at the same time opened up offsetting positions, maybe slightly smaller, worth $1.5 billion. Bets that would pay off if the market did the exact opposite, meaning he may only be directionally biased in a bearish direction to a very small amount. These types of trades are extremely common among advanced options traders, where if the market does absolutely nothing, you make a little bit of money, and then if the market makes a big move, you make more. Essentially, you're trying to limit your risk by taking some of the potential loss off the table. This is why it is vital, in my opinion, to understand market mechanics, to really know how markets work, to understand that machinery that drives economies behind the scenes. Because on the surface, this looks like a famous person who got famous from a movie detailing how he shorted the housing market and was one of the only people out there willing to see how bad things were going to get, and he profited massively off of it in the face of a lot of adversity. And now that person is coming out again for the first time, making his biggest short since then, and this time it's betting against the stock market. This could very easily fool a ton of people into losing a ton of money, simply because they don't understand something as simple as options strategies. That no, he absolutely did not spend 93% of his entire portfolio on these puts. He spent a small fraction of that. And his net cost may have actually been close to zero if he did have any offsetting short positions. Now, for the record, I am bearish on the stock market. I'm not net short personally. I am still net long, but I have tail hedges in place. And if the market crashes from here, I'm going to make a ton of money. But if it doesn't, the amount I lose will be very small. This is how big money does it. And unfortunately, it's very likely that a lot of financially illiterate people will take this and simply sell everything, go to cash, or try and even short the market with unlimited risk to the upside. And now you know better. And if you can believe it, every single thing that we've discussed in this video is a very, very small part of just my advanced options strategies course that I have in my Heresy Financial University. So members of Heresy Financial University get unlimited access to every single course I have, and I'm constantly putting new content in there. And it's all advanced investing strategies like this. The options course is just one of many that I have in there in my training library. And so if this interests you at all and excites you like it absolutely excites me, I invite you to check it out. Link is in the description below, and see how much more money you can make, and more importantly, how much you can stop losing by understanding some of these advanced investing strategies. As always, thanks so much for watching. Have a great day.